Welcome back and thanks for being with us. Special conversation with an analyst who doesn't talk much. We have Nitin Agarwal, head of BFSI Institutional Equities at Motilal Oswal Financial Services. Nitin, always wonderful to talk to you. Before I go to my first question, let me quickly sum up what the quarter has already looked like, at least for the moment. More numbers to trickle in. But when you're looking at the small finance banks and the PSU banks, very, very sharp growth seen there, especially when you're looking at the sequential numbers, even despite the basis being high for PSU banks. Among the larger banks, largely inline set, something like an HDFC has in fact disappointed the street a bit, if I can call it that, based on the move today. And then you had a mix set from the NBFCs, Bajaj Finance, M&M Financial. So some of those have also come out with numbers. Nitin, your first observations from the kind of numbers that have come out, what stood out for you?
Yeah, hi. Good morning.
Hi. Good morning.
So numbers overall looks pretty healthy, especially on the business growth front. Many banks that have come out, especially the PSU banks, we have seen fairly strong numbers. Some of the mid-sized banks that have come, say, the likes of AU Bank, Equitas, pretty strong loan growth numbers we have seen Q on Q. And I think this indicates to some improvement in the underlying asset quality situation, especially in unsecured. So this quarter, we will hopefully see some moderation in slippage run rate. Portfolios looking to stabilize after a very sharp decline over the years. And while this entire pickup in the overall loan growth that we have seen, especially after the GST rate cut, with that sustaining in 3Q and 4Q, anyhow being one of the best quarter for the industry typically, I think this momentum will likely continue and we will end the year at a pretty healthy credit growth around 12% YOY, something that we are looking at.
Okay, and largely, while everything looks good in terms of the quarter 3 updates that we've seen, Nitin, talk to us about some concerns that you are spotting. What is your take on microfinance? How has that performed? And then there are select stocks like RBL and Yes Bank where we are seeing some pressure in terms of their updates.
Right. So MFI sector, all through the year, has been seeing asset quality challenges, and that is reflecting the loan growth numbers, wherein the book is declining quarter to quarter. Now, this quarter, we are looking at some stability in the portfolio, while the SMAs and the forward flows will still drive elevated slippages. But on a Q-on-Q basis, we expect slippages to moderate slightly this quarter, and this will further improve in Q4. So, and month on month, the collection efficiency numbers across many MFI lenders has already crossed 99. Some are at 99.3, 99.4. So they are very marginally away from the normalized collection efficiencies, which is something they will reach sometime in Q4. So to that extent, I think MFI industry will start to move towards normalcy in the next few quarters from here. And the trough as such in terms of the pain points around collection efficiencies and slippages is largely behind. And sorry, the other question that you asked was around?
It was on RBL Bank and Yes Bank, specifically those two stocks, and maybe that pocket of the financial space where we are seeing some stress?
Right. I think RBL Bank, see, the concern has been on asset quality mainly from MFI and credit card. Now, credit card, we are still seeing that the industry is still yet to achieve normalcy. We are still seeing elevated slippages in that space, and the growth has been relatively more modest. The only listed card player, the SBI card, we know the numbers in terms of how the asset quality has been performing and the credit cost running at elevated levels. And I think while Q on Q things will start to recover, but it will still take time for the card industry as a whole to move back towards normalcy. Amongst that, within that, I think the larger banks definitely are doing a much better, delivering a better performance with your ICICI Bank, HDFC Bank, and even Axis Bank calling out that the card portfolio has now stabilized. So I think that is still to be seen with some of the mid-sized names, wherein RBL Bank has been reporting a slightly higher slippages. But with RBL Bank, of course, with the ongoing transaction, I think that is going to be a much bigger driver for the stock than just the quarterly numbers as such, wherein we are expecting numbers to improve Q on Q and bank gradually moving on towards their goal of 1% ROA. I think they may be somewhere around 90 basis point kind of ROA in Q4, which is considerably better from where they are. And then it will improve further in FY27 is what we think.
Nitin, I wonder how you're chalking the margin trajectory of the banking system as a whole. Do you believe that the worst in terms of margin decline is now behind us? Okay, let me rephrase. have margins bottomed regardless of the 25 basis point rate cut? Do they continue to recover despite the 25 basis point rate cut that we got recently? Or do you see a bit of a slip up in terms of margins before the recovery starts to kick in?
Yeah, that's actually very interesting. And we think that margins are somewhere closer to the bottom. This quarter will be a mixed quarter in terms of margin performance. We will have some banks who will go on to report NIM expansion, wherein our estimates are implying expansion for banks like IDFC Bank, Kotak, uh, Bandhan, Equitas. These banks will report NIM expansions over the quarter, even AU Bank. And some of the larger names, say like Axis, they have deferred their NIM stability or NIM improvement guidance to fourth quarter by first quarter of fiscal 27. Will see some decline. And select PSU names also will see marginal decline in the quarter. So I think the movement will be very narrow in terms of the range between the decline or the improvement from here. But from Q4, you can see a more broad-based improvement in margins for the sector.
Okay, and shifting focus, Nitin, let's talk about some NBFCs, particularly your M&M Finance, Bajaj Finance, and the growth slowdown that we've seen in Bajaj Finance. In fact, it's been the slowest in the last 5 to 7 years, if I'm not wrong. You're reading on these numbers?
So growth rate, yes, there is a tad of a moderation in terms of growth that we have seen, and but for us, like it is more on the expected lines. I think some signs of that was visible even in the last quarter results, and given the overall moderation in the system growth, especially in even retail, if you look at like even for the banking system, the retail loan growth used to be the big driver for the overall loan growth, and there was always a gap between retail and the overall loan growth. Now that gap has essentially like kind of come down very sharply. And now we are again seeing signs of retail revival with the unsecured growth coming back towards normalcy. So I think that's something that along with that, some pressure points on the SME financing also has impacted the growth for Bajaj overall as such, the unsecured and the SME space, and which is where the growth rates appears to be a tad lower versus what we have seen in the past. But for us, at least for this quarter, the numbers are more in line, I'll say.
Just the disbursement number of M&M Finance, Nitin, at 30% QOQ was very, very sharp, right? What do you make of that number? That's point number one. Do you see that the CV cycle has completely turned around? Is this probably one of the indications? And therefore, how best do you play the CV cycle? Do you play through an M&M Finance? Do you then go to a Shriram Finance? Do you go to a Chola Finance? How do you play it?
I think CV cycle overall looks to be gaining some ground. We have seen a fair bit of pain, while the pain has been a little kind of selective or not so broad-based in general. There were players who were already doing well within the CV financing, but there is some stability and recovery now we are seeing in the CV financing space also. And vehicle finance as a space overall is looking pretty healthy in context to both the growth and the NIM recovery also. Because on one hand, your cost of funds is also coming down as the growth opportunities are getting better. And within the space, we relatively prefer Shriram Finance, wherein we think that the growth rates and outlook with this transaction that has been announced recently looks to be pretty strong. So Shriram Finance remains our top pick within the vehicle financing space.
Okay, so that's the take over there. Talk to us about some of the gold loan financiers, particularly, Nitin, the kind of run-up that we've seen in something like a Manappuram, Muthoot. How sustainable is this? Because yes, gold prices have been inching higher, but fundamentally, what is the internal performance looking like from some of these gold financiers?
I think gold financiers is like a direct proxy, the play on the underlying gold price, wherein we have seen as to how the metal price is going up, and with the kind of developments, geopolitical kind of changes that are happening and the kind of news flow that is there, possibly we will continue to see the strength in these names over the year. And underlying valuations, yes, looks slightly stretched, but given the kind of loan growth that is coming along and the momentum overall in terms of the gold price that is staying on and only getting better, I think these names will continue to do well over the years.
Nitin, how best do you play? Within the banking or rather within the lenders pack? how best do you play? Do you play through large private banks? Do you play through PSU banks? Are there specific bottom-up ideas that you have and no real general theme? Give us a sense of that.
So actually, see, banking sector as a whole the performance has been very divergent over the last 3 to 5 years. If you look at, there are banks like ICICI and HDFC Bank which have delivered very well, but at the same time, there are many other names who have been more stagnant, and the performance has not been much. So we continue to be stock specific in our selections in the entire sector, and within the large private names, we continue to like ICICI and HDFC Bank. Amongst PSUs, SBI, PNB are the preferred ideas for us. And within mid-size, we like AU. That has been the idea that we have marketed all through the year.
Nitin, last question with regard to HDFC Bank in particular. The growth was largely in line with expectations, but what stood out for me was the loan to deposit ratio again declining. It's again inching towards 100%. Concern for you at all? I know that the liquidity cycle is in favor of the banking system as a whole, and therefore it's less risky compared to what it was a year back. But is it at all a concern for you? Because the glide path that they gave was they'll get to 85%, but that just seems to be inching away from them.
Yeah. So yes, the kind of improvement that we saw in the CD ratio earlier, I think the recent quarter, the focus has again turned back on loan growth, and which is aligned to the bank's guidance that they will want to match the system growth in FY26 and go higher than the system in FY27. So I think that the glide path incrementally looks like will be more kind of at a more moderate pace. And while Q4 generally has been pretty strong for HDFC Bank in terms of deposit sourcing, so overall for the year, we will still see a decline in CD ratio as Q4, this strong accretion comes in. But over the coming year also, it looks like given the pace at which things are evolving, that it will take some time for them to reach to 90 or lower on the CD ratio. So those expectations, yes, are to be rebased. And that has some read-through, yes, in terms of how the sustainable loan growth number you can look at for HDFC Bank, because there is still some journey, some gap that they need to cover on this metric.
Okay, Nitin, appreciate that view, and thank you so much for your time today. On that note, we'll let you go.
Thank you so much.
Okay, so that was around